I now invite Shri Ajay Shah to speak on moving towards global integration. Shri Ajay Shah.
Thank everybody for being in this very interesting meeting today. I just want to take 3 steps back from all the things that have been said, and I want to help put some context into what is going on. So all of you would have been aware of the discussions and debates and criticisms in Indian finance for a long time. And as Ashish and others have emphasized, a lot of this has come together in a single document, that is the Indian Financial Code drafted by FSLRC. Now the question is, how does this get implemented? And for some time, all of us were a little curious and skeptical that how is this going to be implemented. With the previous government in the UPA, the sense was that we don't have a majority in the Lok Sabha, we don't have a majority in the Rajya Sabha, and enacting a big complex legislation like this is going to be impossible. That changed after the elections of 2014, where suddenly it has become possible to do legislation in Lok Sabha and potentially in the Rajya Sabha as well. So the environment has changed considerably in terms of the possibilities. And the new government was keen on reopening some of these basic questions and trying to do a better job. So what seems to have happened in the budget speech and the finance bill is that some very important initiatives have come together. These are not the same as passing the Indian Financial Code, okay? But I think it is an important piece of progress which takes us closer to that goal. So let's think of some of the pieces. So the first big piece, which everybody has talked about, is this single market concept. The key intuition is that trading is trading. Whether you trade gold futures or you trade Nifty futures, there's really no difference. So no matter what be the financial product being traded, the machinery of the market system is really the same. And that gives natural economies of scale in terms of putting these things together. Now, does this mean that there will be no specialization? I think what is useful is to say that it is the choice of each firm how specialized it wants to be. So think like in the real economy. One firm might like to make cotton fabric. Another firm might like to make artificial fabric. It's their choice. Or if one firm wants to make both, it's their choice. If you think that there are economies of scale of the equipment, of you bring both together, it's your choice. The government is not saying that these two things have to be done separately. So I think that is the key point, that it should not be a government which says that bonds are different. It should be the choice of the financial firm. If Jayesh's firm decides that we will only do bonds and we don't have the skills, the talent, the franchise value, the competitive advantage to do equities, that is their call. If Dipti's firm says we want to do both equities and bonds and commodity futures and currencies, it is their call. So the point is, government should not be making this call. There are natural synergies in these markets. Now let people choose. So if one exchange wants to be a specialist, if Sameer's exchange says, I only want to do agricultural commodity futures, that is their choice. But if Sameer's exchange feels that I want to also trade Nifty futures, that should be their choice. It should not be the government which says that we will cut up this industry into separate verticals and forcibly keep each player inside a vertical. I think that's the first big idea, that there is something deep inside all organized financial trading, which is the same. It is some trading system, it is some clearing, it is some mark-to-market, it is some margin, and it is some depository. So no matter how you look at it, there are economies of scale in doing all this work. Everybody in this room is doing the same work, but we've been cut up into different pieces. I have a bit of intuition here which may help think about this. I think of organized financial trading as 3 activities. Okay? The first is a housekeeping activity where you have all this computerized processing of trades. Okay? So in an ideal world, it's straight through processing that my bank accounts, my depository accounts, the exchange, the securities firm, everything is wired together. So you put a trade and there is just processing work. Okay? So there's a very mundane processing work where the order flows, goes into some order matching system, gets matched, some margin gets paid, some depository settlement happens, some clearing money moves in and out of a bank account. So this is the most basic layer. Here it seems to me that the economies of scale are dramatic. This is the same. No matter what part of the market you operate in, this machinery is the same. Then the second level is what I think of as relatively mechanistic trading, which is now all algo. Okay, this is the arbitrage activities. So there's the garbage collection activity of finding mistakes in two prices and bringing the prices together. And this is entirely algorithmic in the modern world. And now once again, I want to say, if you pause to think about it, a spot futures arbitrage on gold is not that different from a spot futures arbitrage on a share. It's not that different from a covered interest parity arbitrage on the currency. So these are all, the formula changes, the basic work is the same. So yes, if I'm doing a covered interest parity arbitrage on the currency, it's a different formula that I will write into my program. If I'm doing a spot futures arbitrage on an equity share, it's a different formula I'll write on the program. But apart from that, it's actually all the same. So I think that when you pause to think about it, this is also something which will work horizontally. That inside the algo trading at BSE, you will get all these kind of strategies being rolled out. And then I think there are economies of scale. That the same firms will end up doing that kind of what I call garbage collection work, that there are mistakes in the market. Somebody needs to step in and make money by eliminating those mistakes. So all the formulaic pricing relationships are established. Then the third and the highest skill in the market is that of actually understanding the product, of actually having a view on what will happen to the price of gold, of actually understanding whether the share of Reliance is underpriced or overpriced, of actually having a view on whether the 10-year rate is going to go up or go down. Here, probably the economies of scale are more limited because it is incredibly hard understanding each market. So here there may be separate players. There is a natural role for a person who really understands wheat. And the person who truly understands wheat is probably different from the person who truly understands the exchange rate. And that's okay. So I'm not here to say that all parts of this market will be done by the same persons. So I'm here to say that let people choose. Maybe there is an intimate interconnection between gold and wicks trading. So then maybe the same person wants to trade wicks and gold, and in his mind these two come together. It should be the decision of the person. It should be the decision of the firm. It should be the decision of the private sector, how these things are organized. It should not be the decision of the government. So I'm just saying that the key insight is let's get government out of it. Let the market system choose whether one particular fund finds it efficient to trade gold and Nifty together or not is the call of the people inside that organization. It should not be the call of the government. So the vision of unified securities trading is about saying that, look, there are some deep commonalities in these markets. Now let the private sector decide what is efficient. If somebody wants to start a firm which only does yield curve arbitrage, okay, please do so. Nobody prevents you from doing that. But if the guys doing yield curve arbitrage find that actually this is no different from doing covered interest parity arbitrage, okay, fine, you do that. Okay, so this is the idea number one, which is, can we bring all these markets together? And in the budget speech, three big pieces have been integrated. The erstwhile SEBI, which is equities and corporate bonds of more than 1 year maturity. Then the erstwhile FMC, which is the commodity futures. And the third is government securities. All these have been put together into one single unified market system. Just for clarity, there's a very confusing word called money market. I find it easier to not use that word. Okay, a government bond is a government bond is a government bond. If it has 1 day maturity or 1,000 years maturity, there's no difference. It's a security. It's got an ISIN. You trade it. There's nothing special about the word money market. So we should just focus on the word security. That if there is an ISIN, somebody is buying, somebody is selling, it's a security. So all government bonds come together and they join this main market. So I think that for everybody in this room, this is going to be an important and dramatic new period where we will need to choose business models. So every organization in this room will think, what business do you want to be in? And then it should be the decisions of the persons in this room that determines the structure of this market, not the central planning of some government which says that this market will be kept separate from this market. Okay, this is the first big idea. The second big idea is PDMA. Everybody has already talked about it, that you need an investment banker for the government. And as Tarun emphasized, this is a subtle and sophisticated problem. It is not a mechanistic problem. I'm sure everybody in this room knows, at present in India, there is no single view of the entire activities of the government in borrowing and in contingent liabilities. The Ministry of Finance presently does the foreign side of it. The RBI does the domestic side of it. There is no database where these come together. So Tarun was saying it's an important call. Do you want to issue in dollars? Do you want to issue in yen? Do you want to issue in rupees? Well, I will say before you make that call, you need to bring the data together. That will happen for the first time in the construction of the PDMA. So we will get a new organization which will look at the full activities of the government bond market. And I think that this is a big and interesting and complex problem. India's GDP is roughly $2 trillion. The overall government debt is something like 65 or 70% of GDP. So this is an investment banker running a book of $1.4 trillion. It would be tantamount to being one of the biggest financial firms of the whole world in thinking about this balance sheet. And I think that they will be well incentivized in understanding how to make a deep and liquid government bond market, because they would have to get the lowest cost of borrowing. The separation from RBI is important in two respects. First, because it is a conflict of interest for RBI to pursue inflation, which means sometimes raising rates, and to pursue the investment banking function, which means always trying to keep the rate low. They are different objectives. Another aspect of this is banking regulation. RBI, in his capacity as an investment banker, can make his job easy by increasing the SLR. So when the SLR is high, banks have no choice. Banks are forced to buy these government bonds. Then the job of the investment banker becomes easier. It's good to separate these things out, that the banking regulator should think about how to make banks safe and sound. The investment banker should think, how am I going to sell these bonds and to who? If you put these things together, it generates bad outcomes. The third big change is clarification of the role of RBI. All these years, we've had an RBI Act which was set up in 1934, which was really not clear about what RBI is all about. And I'm sure all of you know, it is very amusing. Right in the preamble of the RBI Act, our colonial masters say, and this is, I'm quoting from the preamble of the RBI Act, it says that in the present state of disorganization of the international monetary system, it is not possible to determine what is an appropriate monetary policy arrangement for India. Hence, as a temporary measure, we create the Reserve Bank of India. This is right up there in the first para of the RBI Act. And that was done in 1934. The world is different in 2015. We understand a lot more about how these things are done, and it is time to start setting up a sound institution. So I think there are serious problems. There are birth defects in this organization, which have given us all the problems that we have seen. So our difficulties with RBI are not a reflection on the individuals. It is really an impossible job to try to be all these things and do so many different things. So now for the first time, RBI has an objective. It has an inflation target. It has to deliver CPI inflation between 2% and 6%. Okay? What has inflation been in India in the last 15 years? It has been between 2% and 16%. Okay, so that is a failure of printing money in India, that we've got inflation between 2% and 16%. Now RBI will have a clear mandate. He has to deliver between 2% and 6%. And this is accountability. All of us will be able to look at CPI data and know whether RBI is delivering on this or not. So that is a very healthy arrangement where we create accountable government agencies who are mandated to do a job and are held accountable for doing that job. Along with that, many extraneous functions have to go out. It doesn't make sense for a central bank to do investment banking for the government. It doesn't make sense for a central bank to run regulation of the government bond market. It doesn't make sense for a central bank to run an exchange where bonds are traded. It doesn't make sense for a central bank to run a depository where government bonds are stored. It doesn't make sense for a central bank to do regulation of capital controls, and so on. I could go on and on. So there are all sorts of unlikely functions which have been thrown together, and it is important to now rationalize these things, to put this work at the right place and achieve clarity and accountability. Now, for all of us with a private sector background, we know that corporate restructurings happen all the time. Right? This is no big deal. It's a part of life. It is painful. Now, in many a corporate restructuring, the stakes are actually high in the sense that some people lose their jobs. Right? So corporate restructuring can be politically dangerous because some people are going to lose their jobs. In government, corporate restructuring actually has very low consequences because nobody ever loses his job. Okay, so what is going on is just some corporate restructuring. There's some civil servant who's doing some work. He moves to another banner. He carries a different visiting card. Nobody loses their jobs. So I don't see what is there to get excited about. So when we do corporate restructuring, we all work for the people of India. We all work for the government. There's no need to get tempers up. So I think that these are important changes, and they will add value, and there is nothing to get excited about. I don't understand why there is so much angst on these trivial little matters of whether I work for RBI or whether I work for PDMA. These are minor details. What is important is to be clear on objectives, is to be professional, is to construct high-quality organizations, and do a good job. Tarun correctly emphasized that this is technically complex. So we've never done public debt management in India in any kind of serious sense. As I said, we don't even have the data in one place, leave alone thinking about it in more sophisticated ways. Government has set up many new institutions in the past. We are all witness of the creation of SEBI, the creation of PFRDA, the creation of IRDA, and so on. There is a new development in the last 2-3 years, which is that there is a whole new professionalism and a new kind of machinery through which government is now creating new institutions. Okay, so how did government create SEBI? They hired some amazing people called Surendra Dave and Ravi Narayan and Nagesh, is he here? GV Nageshwar Rao and so on, and they said, hey guys, please start SEBI. Okay, and those guys sort of rented an office and started trying to build SEBI. Ashish talked about being part of the founding team of NSE. It was similar. Some 5 guys were hired and told, hey, go start NSE. Things are becoming a little better. They're becoming more professional now. What Ministry of Finance has started doing is that for setting up a new institution, they're setting up a task force. The task force is doing a project plan. It is more like building a bridge rather than just a bunch of 5 guys starting to do something. So there is a Gantt chart. There is a clear set of all the work products that are going to lead up to the institution. There is a sensible view that an institution is a set of processes and IT systems. So you need a set of process manuals and you need a set of IT systems. So these spec documents are being written through consulting and IT companies. And a whole set of these formal documents, processes, and IT systems are being put together through which these institutions come to life. So instead of bringing in 5 guys and telling them to start an institution, it's being done in a much more professional way. Now again, these things have always been done for hardware projects by the government in the past. When the government built Bandra Worli Sea Link, it did not hire 5 people and tell them go build a bridge. There is a formal project management about how you build a bridge. Now those kind of formal methods are being brought into constructing the soft infrastructure of the country, namely organizations like the PDMA. So the task force for constructing the PDMA got going in September last year, and by the time of this budget speech, there was enough confidence that a good deal of work has been done and we have a sense of the lay of the land, and that gave confidence to go through with the next set of measures. As you can see, all these things are tightly interconnected. If you don't have a properly functioning bond market, the PDMA's job is difficult. If you don't have a properly functioning bond market, the inflation targeting is difficult, because when RBI changes the rate, as we know with banking in India, not much changes. So the real monetary policy transmission will work through the bond market, and it is absolutely essential to have a proper bond market with yield curve arbitrage so that the inflation targeting will actually happen. If the PDMA is not taken out of RBI, then RBI remains conflicted because he has an incentive to keep interest rates low and so on. So these things are all complicated and interconnected, and part of why many of these changes did not get done in the past is because if you look at any one of them in isolation, it looks too difficult. It seems that the rest of the machinery is not there. What is interesting and important and remarkable about the thought process at the Ministry of Finance in early 2015 was this sense that if we do the whole thing together, it's actually easier, and the whole thing is going to work much better. So, as Ashish said, we had a really exciting time with financial reforms in the early 90s, and it led up to 2001, where we got the equity derivatives going. And for a long time, there's been quite some stagnation in Indian finance. We've just not made progress. And I'm really excited about what these changes and announcements now imply. And for everybody in this room, life is going to change in important ways. And we are back to the process of thinking what would an appropriate strategy for each of us be in this new world.